Welcome to the Mississippi State University College of Business Family Business Education Initiative responding to COVID-19. And today's session is on the Paycheck Protection Program, PPP, loan forgiveness with Scott Singley, an attorney with Brunini here in Columbus, correct?
That's right.
Appreciate you being here. There's a lot of stress, a lot of anxiety out there with business owners. And, you know, it's tough for the layman to wade through all of what's going on and all the opportunities. So we're glad you're here to talk about that.
It's good to be here.
What are we going to cover today?
Well, we're going to talk about the federal Paycheck Protection Program, which was part of the massive $2.2 trillion stimulus package that the federal government passed, commonly referred to as the CARES Act, back in March. And there are many aspects to the CARES Act. You know, there were direct stimulus payments to families. There was money provided to the states, to the hospitals. But the PPP was intended as a lifeline to small businesses, which really form the backbone of our economy, both here in Mississippi and nationally, to preserve small business jobs and also to help essentially help small businesses essentially keep the lights on while they're navigating through this pandemic.
It's been tweaked a couple of times already, right?
It has been. You know, as with a lot of legislation, it's hard to get it right the first time, particularly when it's passed as hurriedly as this was. So there have been a couple of amendments. The first one was because really of the popularity of the PPP. It was so popular that the funds that were initially allotted for it, over $500 billion, were quickly exhausted. And there was an initial amendment to provide some additional funding. And there was another amendment that addressed some issues that needed to be tweaked that we'll talk about some here today. But in addition to that, the U.S. Treasury Department has issued or answered 49 frequently asked questions, trying to provide additional guidance, and also issued 22 interim rules providing additional guidance. So there's a lot there for the small business owner to wade through, both with regard to eligibility for loans and now forgiveness. And Jeffrey, had we been doing this program in March or April, I think we would have been here talking about eligibility and what do I need to do to get a loan.
Right.
You now have, as of June 27th, there's over 4.8 million loans out there to small businesses, involving over $500 billion. So now the question on everybody's mind, now that most small businesses who wanted a loan, were eligible for a loan, have a loan, is how do I take advantage of the opportunity to have it forgiven?
Right.
Because that's a unique thing. The SBA, Small Business Administration, has had a loan program for many years for small businesses, and this is being funneled through the SBA's loan program. But the unique thing about the PPP loans is if you meet certain guidelines, you can have the loan forgiven. It essentially becomes a grant.
And I imagine most businesses are counting on getting the forgiveness versus paying back the loan.
Oh, absolutely. And they're low interest loans. So in the world of lending and credit, they're good loans. But the idea here is that if the funds are used for their intended purposes, the federal government wants the small business to have the benefit of having the loan forgiven. So that's what we're going to focus on here today is, how as a small business do you obtain forgiveness of the loan?
Okay, well, and then one of the important pieces of that was the June 5th amendment reduced the percentage from 75 to 60% of.
Yeah, and we'll talk about this. Generally, what the federal government was trying to achieve through the PPP is a stabilization of small businesses and the small business labor market. And so when you're looking at forgiveness, they're essentially, the government's going to be looking at, and the lenders are going to be looking at, how well did the small business do in achieving the purposes of the program. And so they're going to be looking at how was the money spent. They're going to be looking at how well did the small business do at preserving jobs, and how well did the small businesses do at preserving compensation for employees.
Walk us through some of these guidelines now.
Yeah, absolutely. So actually, we may want to back up a slide, Jeffrey. Yeah. So let's talk first about what are some eligible costs that you can spend the money on. So essentially we're focused on how the money's spent. It's split into two categories: eligible payroll cost and non-eligible or eligible non-payroll cost. And you mentioned earlier the percentages. Okay, so when this PPP was initially passed, the rule was you had to spend 75% of the money on eligible payroll cost. Okay, and you had another 25% that you could spend on eligible non-payroll cost. The problem that created is that because of the shutdown that was mandated by state governments, municipalities, etc., all over the country, is that many small businesses were saying, this isn't doing us any good because we don't have enough money available to keep the lights on. So what good does it do to maintain payroll if we don't have enough money available to pay our rent, to pay our utilities, etc.? So in response to that, that was one of the amendments addressed in terms of providing additional flexibilities. They changed the percentages to 60% for payroll cost, 40% for non-payroll cost, to provide more cash to the small businesses to pay those basic expenses. So in terms of eligible payroll cost and eligible non-payroll cost, we focus on a certain time period called the covered time period in determining how those monies are spent and whether they're spent on eligible items. So initially the covered time period had to be an 8-week period beginning with the date the loan was dispersed. Okay, that caused some problems for a lot of small businesses because they couldn't operate during that time period. Many of the loans were dispersed in April, May, because they were shut down.
Right.
They couldn't operate and they were having trouble spending the money because frankly, they were, the lights were out. And so in response to that, on June 5th, one of the amendments, addressed that by extending the time period for the covered period to 24 weeks, or no later than December 31st, at the end of the year. Now, recipients who received loans prior to June 5th can still opt to use the 8-week time period, and there could be some advantages to that we'll talk about later in the program. But basically now, if you got the loan before June 5th, you got the option between the 8-week period and the 24-week period. If you got your loan after June 5th, then you got to live with the 24-week period. Now, one unanswered question, and the whole PPP situation is ever evolving, and one unanswered question that further guidance I think will come on is, well, what if I've spent all my money after 12 weeks or 13 weeks or 14 weeks? Can I go ahead and just shut things down then and evaluate my eligibility for forgiveness to get my application in? Well, we don't know. We don't know. We need further guidance to determine for those folks if they've got to wait to the end of the 24-week period to apply, or if they can apply once they've spent all their money.
So when and how is that guidance going to?
It's either going to come from the U.S. Treasury Department issuing another answer to another frequently asked question, or another interim rule, or it may come through legislation to get the answer to that question. Now, I think the answer ultimately will be, okay, if you've spent your money after 14 weeks, you can treat 14 weeks as a covered period. That's what makes sense, but we don't know that for sure yet. So that's one of those things that's hanging out there. That's a kind of a hot button issue right now on the PPP forgiveness side, is that particular issue.
Would they roll any of those questions or answers into the next stimulus package, or would it be separate?
It's very possible. And there is a stimulus package, as I'm sure you've seen in the news, that's being discussed currently.
So let's talk some more about the eligible payroll costs.
Yeah, eligible payroll costs. So they consist of cash compensation, which would include gross salary, wages, tips, commissions, similar compensation. Essentially what you're seeing on your paycheck. But there are some caps in place on that. So the federal government didn't want really highly compensated employees to be included in this. So essentially anyone making $100,000 a year or less, you can count. If they're making more than that, you can't count them. The specific caps for the 8-week period is $15,385 in cash compensation. If you're using the 24-week period, it's $46,154. That essentially comes out to $1,900 a week for either one. You also include payments that you may make to your employees for vacation, parental or family leave, medical or sick leave. However, there's something called the FFCRA, which is paid sick leave that was created specifically for the coronavirus. There are some tax rebates that come along with that if employers provide it. So that's been carved out of this. So if you've made paid sick leave payments under the FFCRA to employees, you can't count that. You can't
looks like double
count.
dipping.
It's going to be like double dipping, that's right. You can also count allowance for dismissal or separation. So like if you provided severance pay to someone upon dismissal, you can count that. You can count employer contributions for healthcare benefits, other insurance premiums, contributions to retirement plans by the employer, so like matching funds for a 401k would be included there. The employer portion of state or local taxes, for example, the employer's portion of the unemployment insurance tax can be counted. And one important point is these rules I've talked about here for eligible payroll cost would apply to just your regular employee. Now, if you've got an owner employee or someone who, like myself, is self-employed, or someone in a general partnership, the rules somewhat vary. So, if you're in that situation, you really need to talk to your CPA or your attorney to help wade through those issues. It's really, kind of beyond the scope of what we're dealing with here today. But it's the same general concept, but the rules are somewhat different for those categories.
Well, let's move on from eligible payroll costs to eligible non-payroll costs.
And what I just talked about previously is the 60%. So you've got to spend 60% on the eligible payroll costs, as we talked about earlier. Okay. So the 40% or up to 40% you can spend is on eligible non-payroll costs. And so those would include payments of mortgage interest, real or personal property. That would not include the payment of principal, so just the interest on the mortgage. And that mortgage must have been incurred prior to February 15th of this year. So if you acquired a mortgage after the pandemic, arose, you don't get credit for that.
Okay.
If you rent or lease, your building where your business operates, you can count rent or lease payments for real personal property. Again, it has to be a lease agreement that was enforced prior to February 15th. Then also payments for utilities. So your light bill, your water bill, your gas bill, telephone bill, things of that nature that you use to keep your business running. Again, there's a February 15th cutoff on that as well.
It's important when these expenses are paid or incurred, or when these costs, right?
That's right. So the expenses have to have been paid during this covered period, whether it's the 8-week period or the 24-week period, or incurred. Okay, the paid part's easy. If you paid the bill, you pay your employee's paycheck during the covered period, it's considered paid. Where incurred is important is, so for payroll costs, they're incurred on the day the pay is earned. But you could have a situation where you're approaching the end of your covered period, say the 8-week period, and you've got the last couple of weeks of that where you've got pay that's incurred, but payroll date's not until after the 8-week period. Okay, so if it's incurred during that 8-week period, but paid during the next payroll cycle, say your 8-week period ends on July 31st and payday's August 1st.
Right.
As long as it's paid on August 1st, you can count it. It works the same way for non-payroll costs. So, you're typically going to pay your mortgage or your lease payment on the first of the month for the previous month. Same thing with your light bill, your water bill, whatever. Anything that was incurred during the covered period and is paid whenever that next bill is due can be counted.
What about potential reductions?
Yeah, so this is the big thing. This is kind of what I was talking about earlier. So if they're going to focus on how you spent the money, okay, and then how you managed your workforce, essentially, whether you were eliminating jobs, whether you were cutting pay, etc., and looking at whether the goals of the legislation were achieved. And if they weren't achieved in one or more respects, you're probably not going to be eligible for full forgiveness. You're going to have one of these reductions. They're going to limit what you can have forgiven. And the first of those potential reductions goes to that issue of how you spent the money and whether you complied with that 60%, 40% split on payroll cost versus non-payroll cost. So if you failed to use at least 60% of the money towards eligible payroll costs, there will be a reduction. And here, an example would be if you had let's make it simple. If you had a $100,000 loan, you spent $54,000 of that towards payroll and $46,000 toward non-payroll, your forgiveness is going to be limited to $90,000. So you're still going to owe $10,000. The next potential reduction deals with salary or hourly wage reduction. Business is struggling to bring in revenue due to being shut down or having limited operating capacities like a lot of businesses do now, such as restaurants. An easy way to save money would be to cut salaries or cut wages. PPP is designed to help prevent that. And so you're going to get penalized if you have too much in hourly or salary wage reductions. So the cutoff is 25%. So we're going to compare your covered period, whether that's that 8-week period or that 24-week period, to what your situation was on average from January 1 of this year to March 31st of this year. So we're going to take a snapshot of that January 1 to March 31 time period. We're going to look at the average salary and hourly wages during that time period for your workforce. We're going to compare it to that average during the covered period. If there's more than a 25% reduction, then you're going to have that amount subtracted from your loan forgiveness.
All right, but there's a time in there where they call it safe harbor.
Yeah.
Or what is?
So there's some good news. There's a fallback. Okay. And the fallback is if you had a reduction in salary or wages of greater than 25%, and that reduction occurred between February the 15th and April the 26th, okay, then as long as you restore the cuts by the end of the year, you're good. It's forgiven. Okay, that's the safe harbor.
So, but you also have some considerations with full-time employees, right?
That's right. And so, another potential reduction is what's called the full-time equivalent employee issue. And so what this is basically looking at is, did you cut jobs? And if you didn't cut jobs, did you cut hours? Okay, that's the FTE issue, we use that for short, is focused on those two particular aspects. And the way that's analyzed is we're going to look at the number of average weekly full-time equivalent employees you had during the covered period. And we're going to compare that to one of two reference periods, okay, and the borrower gets to choose. So we can look back at last year in 2019 between February the 15th and June the 30th and take a look at how many average full-time equivalent employees you had during that time period. Or if it's more favorable for the borrower, they can look at January the 20th of this year to the end of February and take a snapshot of that. So we're going to compare those two time periods to see to what extent there were reductions.
And the hours in the work week matter too.
That's right. So essentially in defining the FTE value for each employee, we're going to look at a 40-hour work week. And so we're going to base that on the average number of hours paid per week for the employee divided by 40 and rounded to the nearest tenth. So the maximum FTE for an employee is 1. So an employee who's working 40 hours a week on average is going to have an FTE of 1. Okay. Now, where it gets more complicated is if you got a lot of employees who are working less than 40 hours a week. And so they provided a simplified method that the borrower can use if they want to, and that would be to assign a 1 to employees who work 40 hours a week or more, or 0.5 to employees that work less than 40 hours a week. And you're really gonna have to do the math to figure out if that works for you. Yeah. I would say if you have a lot of employees who are 38, 39 hours a week, they're gonna have a much higher value than 5. That may not work for you as a business.
You didn't tell me there was going to be math in there.
Yeah, well,
there's also the reduction quotient.
Yeah.
And the next slide is.
So
you're going to have to explain this.
The key number in all this and determining what the reduction is, if any, for the FTE is what's called the FTE reduction quotient. And that's big phrase. Essentially, what that is you're looking at the average number of the FTEs during the covered period, which would be your 8-week period or your 24-week period, and you're dividing that by the total average FTEs you had during that reference period I talked about earlier. So it's really looking at, did your total number of full-time employees which full-time equivalent employees, which takes into account the number of employees and their hours worked, did that decrease? Okay, and if it decreased, then you're going to have a reduction in your loan forgiveness, and ultimately you're taking that FTE reduction quotient and multiplying it by the PPP loan amount. So if the reduction quotient is 1, meaning you had no reduction in your FTEs at all between the covered period and the reference period, then you're going to have no reduction in your forgiveness. If that number is less than 1, then it's going to be reduced. And you can give that $100,000 loan example I used earlier. If you have a $100,000 loan and your FTE reduction quotient is 0.9, then your forgiveness amount is going to be $90,000.
But there are also safe harbors with the full-time employees, the FTEs,
Yes,
right?
there are safe harbors, and then there are also some exceptions. We're going to talk about both of those. So there's some opportunities to avoid the FTE reduction if that math we just talked about doesn't work out in your favor. And so the first one of those addresses, a problem a lot of businesses have had. I mean, they've not been able to operate either at all or at full capacity due to state or local restrictions because of the COVID pandemic. And so if you can demonstrate in good faith that you've been unable to return to your pre-pandemic level of business as a result of state or local government ordinances, then you can avoid the FTE reduction. So you're going to have documentation for that. So you're going to need a copy of the relevant orders or guidance that's limited your business's ability to operate, and you're also going to need financial records, both post-pandemic and pre-pandemic, that you can show a comparison and say, hey, there's clearly been a reduction in our ability to operate.
And there are some timetables with this as well.
Yeah. So an FTE decrease, this is safe harbor number 2. Okay, an FTE decrease occurring between February the 15th of this year and April 26th of this year will be forgiven if you restore the FTE levels to the pre-February 15th levels by the end of the year. So again, if you have a decrease that occurs after April 26th, this doesn't apply. But if it occurred prior to April 26th and you get things restored by the end of the year, that's another safe harbor that will allow you to avoid the FTE reduction. All right, and so in addition to the safe harbors, there are 3 exceptions we have to consider on the FTE side as well. And these can all potentially allow the borrower to avoid the FTE reduction. So the first one, all right, there are a lot of small businesses that have had issues, and here's one situation where the CARES Act legislation is kind of contradictory. So one aspect of the CARES Act legislation that is being talked about a lot now is the subsidy that was provided for unemployment. So there's a $600 weekly subsidy that was provided for unemployment on top of what you'd be entitled to under the state unemployment benefits. That was part of the CARES Act also, and that's expiring at the end of this month unless legislative action is taken. Well, the headwind that's created on the PPP side is a lot of employers offered opportunities for employees to come back to work once the doors were opened back up again, and employees have said, no, I'm better off at home because I'm getting this $600 subsidy for unemployment, and they refuse to come back to work. And so small businesses are throwing their hands up saying, well, I can't comply with these PPP guidelines because people don't want to come back to work. And so that's what this first exception is designed to address. So if you made a written offer, it's important. It has to be a written offer. You can't get on the phone and call them and say, hey, you want your job back. It's got to be a written offer. A written offer to rehire an individual who was an employee on February 15th of this year. And that person rejects you, okay, and then you're not able to fill that position with someone who's similarly situated by the end of the year, then that FTE, that person won't count against you in the FTE calculation.
Okay. And then we have 2 more exceptions.
Yeah, same kind of situation with number 2. Say you've made a written offer to restore an employee's hours or to restore their salary or wages to the pre-pandemic level, and that employee has rejected the offer for whatever reason. Maybe they are not in a situation where they can come back to work full time because they're child care, those kinds of situations, then that's another exception. That employee won't be counted against you in the FTE calculation. Again, you've got to be a written offer. You got to be able to show the documentation. Okay. And then there's a third exception, and this, would be for employees who you've terminated during the covered period for cause. Just in the ordinary operation of business, you got to let somebody go because of poor performance or misbehavior. You've got somebody who just quit on you. Or you've got somebody who's requested and received a reduction in their hours, again, because maybe, sickness, need to care for a family member, etc. You will not have those counted against you in the FTE calculation.
And as with anything, it's important to document all that.
You got to document all that. Again, if you don't have documentation, in the event the SBA comes to audit your loan, then it essentially didn't happen. So you've got to document everything. That's vital. And so the way this works, the way these exceptions work is if you have one that applies to your situation, one of those three exceptions we just talked about, and that position's not filled by another employee, you're basically going to use the FTE number for the employee that was impacted at the time the situation happened. Okay, so you're not impacted by what happens going forward with that employee. And again, you got to maintain records to document compliance with all of this.
And if you want to apply for loan forgiveness,
and that's kind of where people are right now. So the general process for applying, there are a lot of people who have been through either the 8-week period or maybe they're in the 24-week period and they've spent all their money. They're ready to apply. So one issue we're going to have to deal with for those 24-week periods, what we talked about earlier, is do you have to wait to the end or can you go ahead and apply now? The general process is there's an SBA form for this called SBA Form 3508 that will have to be filled out. And the form's initially turned into your lender. So all these funds were funneled through private lenders, okay? And so the application goes to the lender. And the lender may have its own application, that's fine. So I think, first step would be to contact your lender and say, what form do you want me to use, the SBA form or your form? Some small businesses may qualify for what's called the easy loan forgiveness application. It's a shorter application. I understand it's much easier, much quicker to fill out. You're going to have to talk to your lender, your CPA, your attorney about whether or not that fits you, but that's an opportunity. The applications are going to require the bar to make numerous representations and certifications. You want to make sure those are all accurate in the event of an audit. And you're going to have to retain your records related to your forgiveness application for up to 6 years in the event of an audit. So like I said, the application is going to be submitted to the lender. The lender's going to make the initial determination on eligibility for forgiveness, and the lender's got 60 days to complete that process. Here's another hot button issue, a hot button problem really that a lot of small businesses are dealing with. A lot of lenders, particularly the larger lenders, are not accepting applications yet. They're just not ready. They don't have their system in place. This is such a fast-moving process. A lot of lenders have not developed their system for dealing with forgiveness applications. And so many lenders have not opened their portal yet. And so there are a lot of small businesses out there sitting waiting to submit their applications, and they're just on hold waiting for their lenders to open the portal and say, okay, it's time. And that's going to change, develop on a lender-by-lender basis. But once the lender gets the application and they review it and approve it, then the lender submits it to the SBA for the SBA's review and approval. That's another issue. The SBA announced this past Thursday that they would not be opening their portal to receive applications from the lenders until August 10th. Okay, so even if your lender currently has your application and maybe has even made a decision on your application, the lender can't move it along in the process to the SBA until August 10th at the earliest.
Wow.
All right, so once the SBA has it, they've got 90 days to make a decision. Assuming SBA signs off on everything, then the forgiveness will be in place within that 90-day period once the SBA makes its decision. Now the SBA's got the right to review that loan, review that lender's decision, review any information they want to review, including your eligibility for the loan and the way you've spent the money while they have that application. But the good news is, I think the average amount of the loan out there is under $100,000. The SBA has indicated that if your loan's under $2 million, they're unlikely to review it. Okay, so most small businesses will not be impacted by SBA review, hopefully. If you've got a loan over $2 million, you probably should get ready for a review. Everyone needs to be ready, so you need to have your documentation in place, all your ducks in a row in the event the SBA decides to review it for compliance. But if you're under $2 million, you can probably breathe a little easier.
This has been a lot. How long did it take you to get a handle on all of this information?
Oh, quite a while, and it's not just me. I mean, we have several of my partners have been working on this as well since the legislation was passed, and consult with clients daily on issues with compliance and trying to prepare themselves now for getting the maximum amount of forgiveness possible out of their loan.
So, to wrap up, you'd suggest any business out there that is looking to go through this process needs to contact probably two very professional.
Yeah, absolutely.
Your attorney and your CPA. Right?
Yeah, I mean, there's, one, this is an ever-evolving situation. We've talked about several issues that are still gray areas. They're hanging out there. It's changing daily. You need to be in touch with an attorney and an accountant to really assist you through this process, or you're likely to leave money on the table. And we don't want to do that. I mean, at this point in time, most small businesses need every dollar they can get to make it through this difficult process. So we don't want to leave money on the table. And there are plenty of attorneys. I mean, our firm's one, but there are other law firms as well who are well versed on this, who will be happy to help.
Is it unusual for attorneys and CPAs to talk?
No, it's not unusual at all. Attorneys and accountants work together frequently on numerous business issues, tax issues, for example, on a regular basis.
Well, and as always, document.
Yeah, document. I mean, there's always the possibility of an audit by the SBA, and you want to have all your documentation. We not only on forgiveness, but on eligibility as well. We didn't really talk much about eligibility, but the loans were designed to be provided to small businesses who were impacted by the pandemic and needed the funds. There are many businesses who have actually thrived during the pandemic process. Grocery chains, for example. But there are businesses who have thrived who have also gotten PPP loans. So you want to have your documentation in place showing your need for that loan to make sure you were eligible in the event of an audit. You don't want the SBA trying to claw back funds at the end of the day.
Scott, we want to thank you so much for joining us and giving us great comprehensive information. I want to put up your contact information. Scott Singley, Brunini, Grantham, Grower, and Hewes in Columbus. And again, we thank you for your expertise, and we hope you found it helpful for you.
Thank you for having me.